Let's be real. Most people who have 50,000 sitting in the bank don't realize the opportunity they're holding. They see it as savings, maybe for a rainy day, but they don't understand that 50K can be the launchpad to complete financial freedom. The truth is, if you just leave it in the bank, inflation slowly eats it alive, and it never works harder than you do. But if you know how to use it wisely, that same 50,000 can grow, compound, age, and generate cash flow that takes you out of the rat race permanently. This isn't about gambling or chasing risky, get-rich-quick schemes. It's about smart, strategic money moves that turn your 50K into a machine, one that builds wealth for you day after day, year after year. Imagine not worrying about bills, not stressing over paychecks, and knowing your money is working for you while you sleep. That's the power of smart financial choices. So today, I'm going to walk you through 7 money moves that can transform 50K into lasting wealth. These aren't theories, they're proven strategies the wealthy already use. Follow them, and you'll be on the path where working becomes optional and financial freedom becomes your reality. Build a solid safety net before anything else. Here's the deal: if you've got the 50,000 sitting in the bank, that's a fantastic position to be in. But before you get excited about investing in stocks, real estate, or starting a business, you need to do the boring but absolutely essential step first. Build a safety net. Think of it like constructing a house. You don't start with the roof or the flashy paint job. You start with the foundation, because no matter how big or beautiful the house is, if the foundation is weak, the whole thing can collapse the moment a storm hits. Money works the same way. If you rush straight into high growth investments without protecting yourself, one unexpected setback can wipe out years of progress. A broken down car, a sudden medical bill, losing your job. Life has a funny way of testing you when you least expect it. And if you don't have a financial cushion, 8, you'll be forced to sell investments at the wrong time, rack up credit card debt, or take out loans that cost you way more in the long run. That's why the very first smart money move is creating a safety net, an emergency fund, paying off high interest debt, basic insurance coverage. Let's break these down. First, the emergency fund. This is the money you keep tucked away, ready for life's curveballs. Financial experts recommend anywhere between 3 to 6 months of living expenses. For someone with 50K, that might mean setting aside a 15,000 and 20,000 in a high yield savings account or money market account. The key here is safety and liquidity. You want this money accessible, not locked away or exposed to risk. This isn't money that's supposed to grow. It's money that's supposed to protect. Think of it as your personal insurance policy against chaos. Second, tackle high interest debt. If you're carrying credit card balances at 20% interest or payday loans, those are wealth killers. Think about it. If you invest your money and earn 8% returns, but you're losing 20% to debt, you're going backward. It doesn't make sense. Using part of your 50K to wipe out that debt instantly gives you a guaranteed return, because every dollar you no longer owe in interest is a dollar back in your pocket. Clearing debt doesn't just save you money, it gives you peace of mind and frees up future income to invest. Third, basic insurance coverage. Nobody likes talking about insurance, but it's the shield that keeps your financial life safe. Health insurance, car insurance, and renters or homeowners insurance aren't luxuries, they're essentials. Why? Because one accident or unexpected event can cost tens of thousands of dollars. If you're not covered, it can drain your savings in an instant. With 50K in the bank, it would be foolish to skip this step. It's like building a castle but leaving the front gate wide open. Now, here's the part most people don't get. Building a safety net doesn't mean you're being overly cautious or holding yourself back. It actually does the opposite. It gives you the confidence to take bigger, smarter risks. When you know that your living expenses are covered, your debts are under control, and you're insured against disaster, you're no longer scared of what if. You can invest in stocks without worrying about having to sell during a downturn. You can buy into real estate without panicking over a vacancy. You can even start a side business knowing that if it takes a while to take off, you won't be ruined. Think of your safety net as the launch pad for wealth. Astronauts don't just hop in a rocket and hope for the best. They have layers of safety systems, backup plans, and protection in case things go wrong. And guess what? That's why they succeed. Your financial journey works the same way. Your safety net is what allows you to launch confidently toward bigger goals. Let's put this into a real life example. Imagine two people, Sarah and John, both with 50D Zalozen in the bank. Sarah immediately invests all of it into stocks because she's chasing quick growth. A few months later, she loses her job and needs money for rent. The stock market is down, so she's forced to sell at a loss just to cover her bills. That setback delays her wealth building journey by years. John, on the other hand, takes 20,000 of his 50K and builds a rock-solid emergency fund. He pays off his credit card debt and makes sure his insurance is up to date. Then he invests the remaining money. A few months later, he also loses his job, but instead of panicking, he uses his emergency fund to cover his expenses, leaving his investments untouched. When the market recovers, his money grows, and he's still in the game. The difference, John played it smart. He built a safety net first. So before you start chasing growth, remember this: defense wins games as much as offense. A strong financial defense, your safety net. Make sure you stay in the game long enough to win. With 50 Zalozen in the bank, this is the smartest and most important first move you can make. Put your money to work in assets that grow. Know that your foundation is strong with a safety net in place. It's time to do what wealthy people do best: make your money work harder than you do. Because here's the truth: if your 50,000 just sits in a bank account, it's quietly losing value to inflation every single year. Prices rise, your dollars buy less, and over time, you're safe. Money isn't safe at all. The real power move is to place your money in assets that grow, the kinds of investments that multiply over time, generate returns, and create lasting wealth. So, what counts as growth assets? The big ones are stocks, index funds, real estate, and business ventures. Each comes with its own risks and rewards. But the common factor is this: they give your money a chance to expand beyond the limits of a savings account. Let's start with the stock market. When you buy stocks, you're not just putting money into thin air. You're buying ownership in real companies, companies that grow, innovate, and make profits. Over the long term, the stock market has returned an average of 7–10% annually after inflation. That means 50 Zalozen invested and left to grow could double in about 7–10 years without you lifting a finger. That's the magic of compounding. Your money makes money, and then that money makes more money. For most people, the easiest way to tap into the stock market is through index funds or ETFs. These are baskets of stocks that track entire markets, like the S&P 500. Instead of betting on one company, you're spreading your risk across hundreds. It's simple, low cost, and historically one of the best long-term wealth builders. You don't need to be a financial genius to invest in index funds. You just need patience and consistency. Next, there's real estate. With 50 Zalozen, you could use it as a down payment on a rental property. Real estate is powerful because it builds wealth in 3 ways. Appreciation: the property's value goes up over time. Rental income F's cash flow in your pocket. And leverage: using the bank's money to grow your wealth. Of course, real estate comes with responsibilities, tenants, maintenance, and market risks. But with the right research, it can turn 50 UK into a long-term income stream. Then we've got business ventures. This doesn't mean throwing all your cash into a risky startup, but it could mean starting a small side business, buying into an existing one, or even creating a digital asset like an online store. Businesses can generate far higher returns than stocks or real estate if done well. The catch: they also require more effort, creativity, and time. Still, Some of the greatest fortunes ever built didn't come from playing it safe, they came from turning capital into enterprise. Now, here's the golden rule: diversify. Don't put all your 50 Zavarosen into just one place. Spread it out. For example, you could keep some in index funds for steady growth, some in real estate for cash flow and appreciation, and maybe a smaller portion in a side business for high upside potential. Diversification protects you from losing big if one investment underperforms while still letting you capture growth in multiple areas. A lot of people hesitate at this stage because they fear losing money. And yes, growth assets do carry risk. Stocks go up and down, real estate markets shift, businesses fail. But here's the truth: the bigger risk is doing nothing. Inflation guarantees your money loses buying power if you leave it idle. But growth assets give you the chance to beat inflation, build wealth, and change your financial future. Risk isn't something to avoid, it's something to manage smartly. Let's look at an example. Imagine you leave 50 zeros in a savings account earning 1% a year. In 10 years, with inflation averaging 3%, that 50K will buy maybe only 42K worth of goods in today's money. You've actually lost purchasing power. But if you put that same 50K into an S&P 500 index fund averaging 8% returns in 10 years, it could be worth nearly 108,000. That's the difference between staying stagnant and moving forward. The best part is once you place your money in growth assets, you're no longer trading time for money. You don't have to work extra hours or take on a second job. The assets do the work for you 24/7. That's the beginning of financial freedom. But here's the warning: don't chase hype. Just because your friend says crypto is going to the moon or someone on social media brags about flipping houses to the 48 doesn't mean you should dump your money there. Growth assets are about long-term wealth, not short-term gambling. Focus on proven vehicles, stay disciplined, and remember, you're building wealth forever, not just looking for a quick thrill. So if you've got 50,000 in the bank, don't let it gather dust. Put it into growth assets that multiply your money over time. Stocks, real estate, businesses. They're not just investments, they're wealth engines. And once you set them in motion, you'll be amazed at how quickly your money starts to outwork you. Create streams of passive income. Here's the truth about wealth that most people never learn. You'll never get rich by trading your time for money alone. Your job might pay the bills, but it keeps you on the hamster wheel. The moment you stop working, the income stops too. That's why wealthy people focus on building passive income, streams of money that flow in whether they're working, traveling, or sleeping. And if you've got 50 zeros to start with, you're in the perfect position to begin creating these streams. Because passive income isn't about luck, it's about strategy. It's about planting seeds today that will keep producing fruit for years to come. So what does passive income actually look like? Let's break down some of the best ways to build it with your 50K. 1. Dividend paying stocks. When you own shares of certain companies, they pay you a piece of their profits in the form of dividends. It's like getting a paycheck without having to work there. For example, if you invest a 20,000 into solid dividend, paying stocks or ETFs that yield 4% annually, that's 800 a year in passive income. It doesn't sound like much at first, but remember, if you reinvest those dividends, the snowball effect kicks in. Over time, your dividend income compounds and it can grow into a powerful cash flow stream. 2. Real estate rentals. With 50,000, you could use it as a down payment on a rental property. Let's say you buy a small home or duplex, rent it out, and collect 4,500 a month in rent. Even after expenses and mortgage payments, that's cash flow coming in consistently. The beauty here is that the tenants are essentially paying down your mortgage while you collect the income. And on top of that, the property itself usually appreciates over time. That means you're building both cash flow and equity at the same time. 3. Real estate investment trusts are rights. 8. If you don't want the hassle of dealing with tenants and maintenance, rights are a great alternative. These are companies that own and manage real estate, and they pay out most of their income to investors in the form of dividends. With rights, you can invest in real estate without having to actually manage properties, making it a more hands-off passive income option. 4. Digital assets. In today's world, passive income isn't just about physical investments. You can create or buy digital assets that continue earning money long after the initial work is done. This could be an ebook, an online course, or even a YouTube channel. 8. Yes, these require some upfront effort, but once they're set up, they can generate recurring income with little ongoing work. If you're not interested in creating, you could even buy existing digital businesses that already generate income. 5. Peer-to-peer lending or income funds. With 50K, you could also put a portion into platforms or funds that lend money to others and pay you back with interest. Essentially, you're becoming the bank. While this comes with risk, if managed wisely, it can provide steady interest income on top of your other investments. Now here's the key mindset shift. Passive income is not about replacing your full-time job overnight. It's about stacking streams over time. One stream may only bring in a few $100s a month, but add in another stream and another, and soon you've got ones and zeros and 2,000 zeros or even more flowing in without clocking in at a job. That's how financial freedom is built, not by one big leap, but by steadily stacking bricks until the wall of freedom is complete. Let me give you an example. Imagine you take your 50,000 and split it across a few areas, so 20K into dividend stocks, 20K into a rental property down payment, and 10K into building a digital course. In year 1, you might earn 800 in dividends, 2 does 400 in net rental income, and a few thousand from course sales. That's maybe 5,000 and 6,000 total in passive income. Now, you reinvest some of it, grow your digital presence, and a few years later, you're making 15,000 to $20 in a year passively. At that point, the money starts snowballing, and suddenly, working becomes optional. The reason passive income is so powerful is because it breaks the link between your time and your money. Think about it. If you only rely on a job, you've got 24 hours in a day. That's your ceiling. But when you build passive income, there's no ceiling. Your assets work all day, every day, without needing sleep or vacation. And the more streams you add, the stronger your financial position becomes. Of course, here's the warning. Don't confuse passive income with no effort. Most streams require upfront work or smart allocation of capital. A rental property needs research and setup. A course needs creation. A stock portfolio needs planning. But once they're in place, the income becomes automatic. And the earlier you start, the more time you give these streams to compound and grow. So here's the bottom line. If you've got 50s and Zoos, and don't just think about saving or investing for growth. Think about creating streams of income that will pay you over and over again. Because when your money is working harder than you are, that's when you start moving from financial security to financial freedom. Think long and protect your wealth. Building wealth isn't just about making smart moves today. It's about making sure your money is protected, preserved, and continues to grow for decades. Too many people focus only on the getting rich part, but they forget the other half of the equation, staying rich. You can have 50,000, 500,000, or even 5 million, but if you don't think long, poor decisions, market crashes, inflation, or bad spending habits can wipe it out quicker than you ever imagined. That's why protecting your wealth is just as important as building it. Think of your 50,000 not as cash in the bank, but as the seed of your financial empire. If you treat it with care, discipline, and strategy, it can grow into something far greater than you ever dreamed. But if you're careless, it will shrink, vanish, or get eaten up by inflation. So let's break down how to safeguard and multiply it for the long haul. 1. Diversify to protect against risk. One of the most common mistakes people make is putting all their eggs in one basket. They might dump everything into one stock, one business idea, or even leave it all sitting in a savings account. But life is unpredictable. Markets crash, businesses fail, and currencies lose value. Diversification is like an insurance policy for your money. It spreads the risk so that even if one area takes a hit, the others keep you afloat. With 50 zeros, you could divide it into different buckets: a portion in stocks for long-term growth, a portion in real estate for stability and income, a portion in cash or bonds for safety and liquidity, a portion in alternative investments like digital assets or businesses for higher upside. This way, you're not dependent on one single outcome. But the people don't gamble their future. They diversify and protect it too. Beat inflation with growth-focused investments. Here's something most people don't realize: cash sitting in the bank is losing value every single year. Inflation slowly eats away at it like termites on wood. If inflation is 4% and your savings account is paying 1% interest, you're effectively losing 3% of your money's purchasing power every year. That's why a long-term wealth strategy must include growth investments. This doesn't mean gambling on risky stocks, but it does mean putting a portion of your money into assets that historically beat inflation, like the stock market or real estate. Over the long run, these assets tend to grow faster than inflation, protecting and increasing the value of your money. 3. Think about taxes and legal protection. Another way people lose wealth is through unnecessary taxes and poor planning. Governments will happily take their share if you don't structure things properly. That means learning how to use tax-advantaged accounts, understanding deductions, and even considering trusts or legal structures if your wealth grows significantly. 8. If you're serious about building long-term wealth, don't just think about how much you make. Think about how much you keep. Even saving 10 to 20% in taxes each year could mean tens of thousands of extra dollars compounding for you over decades. 4. Build an emergency fund and protect with insurance. Here's where many people get it wrong. They invest aggressively, but they don't keep a safety net. Then life happens. An emergency expense, a job loss, or a medical bill, and they're forced to sell investments at the worst possible time. That's how people derail their financial future. A strong wealth plan always includes an emergency fund, at least 3 to 6 months worth of expenses in a safe, liquid account. On top of that, protecting yourself with the right insurance, Seros Health Property, life, liability shields your wealth from being destroyed by one unlucky event. Insurance isn't exciting, but it's the invisible shield that keeps everything else safe. 5. Have patience and play the long game. This might be the hardest part. Everyone wants quick results. They want to turn 50 zalosen into 500 zalosen in a year. But here's the reality: wealth isn't built in a year, it's built over decades of smart decisions, compounding growth, and disciplined behavior. Think of it like planting a tree. The first year you water it and it doesn't look like much is happening. But slowly, year after year, it grows taller, stronger, and produces more fruit. That's your wealth. If you keep reinvesting, diversifying, and protecting it 10 to 20 years from now, you'll look back and realize just how powerful compounding really is. Here's a quick example. If you invest 50,000 today and earn an average 8% return per year, in 20 years you'll have about 233 zarosen. In 30 years it's 503,000. And if you add regular contributions, it grows even faster. That's the magic of long-term thinking. Your money quietly multiplies while you live your life. 6. Avoid lifestyle creep. Finally, protecting wealth also means protecting yourself from yourself. When people start making or growing money, they often increase their lifestyle to match. They buy bigger cars, fancier houses, and more toys. Suddenly, instead of building wealth, they're draining it. True wealth isn't about how much you spend, it's about how much freedom you have. Every dollar you don't waste on impressing others is a dollar that can grow for your future. So here's the bottom line. Protecting your wealth is not about being fearful, it's about being strategic. You've worked hard for your 50.000, so don't let short-term thinking, poor planning, or unnecessary risks destroy it. Diversify it, grow it above inflation, protect it with safety nets, and above all, give it time to compound. Because when you combine smart money moves with long-term protection, that's when your 50,000 stops being just savings and starts becoming the foundation of lasting financial freedom.